Hi, this is Randy Finney with the Right Side of the Chart, and this is a mid-session update for Friday, January 24th, 2025. It is 2:15 p.m. Eastern Time as I'm starting the video. I just want to get one out before the weekend starts. I'm probably going to cut out today. I don't expect much of anything to happen today. Yesterday was a kind of a non-event day too. That's why I didn't post much. I answered a few questions in the comment section. Sat here, watched the markets most of the day, but today I'll cut out early, which I usually do. Again, I don't see many opportunities today. Plus, it's a Friday. Remember that even a futures trader, whatever you take home on Friday after the markets close and the after-hours session closes, that's it. You own it for the weekend until futures traders start picking up on Sunday evening. The rest of the market, ETF and stock traders, Monday morning. So point being that you are subject to 2 extra days of overnight risk, something that especially future traders don't have that overnight risk from Sunday evening until Friday evening, because futures trade virtually around the clock with just usually a 1 hour shutdown period, at least on the stock futures. So let's just recap. Let me just start out long term. Just recap again. These are the primary uptrend lines off the August 5th lows, which we broke a few weeks ago. We remain below. Bearish engulfing candle. Again, this is a weekly chart, so this is kind of big picture. That sell signal remains intact. I will say this, that the markets have a sort of a history, or if you will, I use the analogy, I've used it many times in the past, like when you hold two magnets in your hand, both hands, and then you put them close together, there's that point, all of a sudden, if you get them close enough, they just kind of snap. That seems to be what the markets typically do when they get close to new highs. They'll punch through there, and then usually after the new high is made, you get a sell-off, or sometimes the high, just like back here. Well, that was the high right there, but there was your breakout right there. You had a breakout to new highs. You went up for about 2 weeks. In the third week, put in a bearish engulfing candle, and that's all she wrote. So maybe that'll be the bearish engulfing the tops. And it is. Like I said before, if you were a long-term trader, bearish engulfing is very simple. Don't overthink it. If you believe it could be the top, and you'll never know until in hindsight, then you short it with a stop above it, and if you take out the top of the candle, then it's no longer a topping stick. Even if you just went up a little bit, next week it's not going to be the top, and you can always get back in short later. But right now, like I said, it's coin toss odds. In fact, my thoughts haven't changed pretty much all this week. I kept things light. I'll get to this in a second. That's something about natural gas futures. Somebody asked me a week ago today, it was Friday, asked my thoughts. So what was Friday? That was the 17th. Go down here, click on that one. They said, what are your thoughts on the weekend? And oh no, they didn't even ask. I just offered it up for free. It's the same thing. I might cut out early today, so have a great weekend to you as well. For what it's worth, I will most likely lighten up or go flat the indexes in my trading cup by the end of the week, based on my low degree of confidence about where the market opens next week. And I think throughout the last, throughout this week, I must have replied 2 or 3 times. People asking my thoughts on the market, exact price targets. I said the same thing. It's just right now, it's a little fuzzy. Add to that, member Kevin K, I think it is, also brought a good point. We have the big FANGs next week. Not all of them, but most of them. Big techs report. And the market always kind of goes into a holding pattern before then, just waiting for those big reports. It's going to make or break things. If you ask my opinion, which way it's going to go, I always say if the charts are indeterminable, and again, I'm talking bigger picture, not what's going to happen the day that each of these big techs report, or that, in the after-hour session. What I'm talking is the next tradable trend. Based on this, the posture of the charts, the big divergences, the bearish engulfing candles, the recent breadth deterioration, and let me speak on that. I know I go on tangents, but since I just said it there, some might say, "Well, no, Randy, we've heard lately we're seeing broad participation." Yes, that's what the cheerleaders on TV are talking about, and I see it and I recognize it. However, things such as the certain sentiment indicators, such as the AAII bull to bear spread, which again is a ratio of how many people are bullish each week versus bull. It's a weekly survey they do to all their participants. And I believe it was the same subscriber, Kevin, that brought up that, oh, bearishness is now ramped up, and that just crossed over. However, as I showed on this chart, that right before that comment was made that same week, a couple weeks ago, what happens is it's after the periods of extreme. This is my red zone. This is the extreme bullishness. When you have the red bars down here, that's extreme bearishness. That's when you want to start getting bullish. And they're not very important. Sentiment indicators are the farthest thing in the world from exact timing indicators. We use the 15-minute charts, the 60-minute charts, sometimes even the 5-minute charts to hone in on when to enter or exit a trade. That's the timing part of it. The trend line breaks, support resistance breaks, bullish and chart pattern breakouts, bullish and bearish chart pattern breakouts. But what this tells you is these are conditions. Just like overbought and oversold is a condition, it's not a buy or sell signal. Just like negative and positive divergences are conditions. They are conditions that historically and typically, more often than not, precede a trend change when you're extremely overbought or oversold or positive or negative divergence. And just like extreme bullishness often precedes corrections, as you can see, all these are the biggest corrections in years since throughout this entire bull market since the '09 lows. And so what is more of a timing indicator, and again, this flips exactly what I tried to say to Kevin, exactly opposite of what most think. Oh, well, everybody just got bearish all of a sudden in the last week or so. Remember the AAII flipped down. Well, that's actually, if you want to use this as a sell signal, that's the closest thing, because as you can see, it's once you come off those extreme levels, it's when the flip comes. That's these purple dotted lines I have right here. That is, in almost every instance, almost exactly or within a couple weeks of when the big drops came. COVID, the Q4 2018 drop, the sideways deer market where we went nowhere but sideways for 18 months in 2015, 2016, the 2022 bear market, if that's what you want to call it, correction. And then most recently, we're coming off again this extreme. So that's one of them. And again, so you can see that breadth surge. Put to call ratio is another one. Let me pull that up for you. Let's go here to... so yeah, it's a sentiment indicator. We'll go to the I like the CPCE. This one here, you can see that these extremes right here. I have two lines right there. This one has done the trick in recent years. It's, again, this is just the measure of put to call buying on the equities, equity only. I'm sorry, it strips out the indexes, so it's stocks. That's put versus call buying. Same thing when it's up here. Everybody's bullish, and that's an extreme contrarian sell signal. And then down here is where everybody gets bearish. And again, sometimes you get these clusters. Now, you don't want to look for extreme bearishness right after a bear market. That was COVID. You already got the bear market down there, and you came down here. Oh, you had the hit right about there, right there. But the last time, if you look in recent years, this has been where we've fallen to. That came right before the peak. The S&P peaked in the very start of 2022. The NASDAQ peaked just before it in November. And then came the drop. We had a hit here and a very close hit. So all I can tell you is that this sentiment indicator is getting very at extreme bullishness. Anything but extremes really don't mean much. And again, I take it in conjunction with other things out there. And then that whole thing I've talked about, we had pretty much an entire year of abysmal market internals. We've lately seen a little reprieve, game of catch up, which is quite normal before top. Now, I can't tell you if the top's coming tomorrow, today, next week, a year from now, but I gave you levels to watch. It'll tell you when it probably is. We broke some of those today, but again, with the big market leaders on deck next week, just not a time to get aggressive long or short, in my opinion. It's going to be a choppy market, And let me get back to the charts here and I'll kind of review everything. So remember, long term, we did have the bearish engulfing candle. We're below the trend line in QQQ. We also recently had a flipped bearish crossover on the PPO on the weekly. On the daily chart, I have different boards here. We'll look at this one right here. Remember, we came off this divergent low, and I made the case, and that we'd get a rally. I gave you maximum and minimum targets, which I just updated. I've been updating these quite a bit recently. The minimum target right here, when we went long off this, was this downtrend line, which we hit. Expect a pullback, then we pulled back, we punched through it. Before we took it out, I said if we took it out, these would be the likely targets, these 2 reaction points. Again, that was given to you back here before the breakout. And that's what we hit the other day, and that's where we remain. So right now, all I can tell you definitively, we're at the upper end of where I expected this 60-minute bullish divergent low would take us, especially once we had the breakout and the successful backtest. This is that uptrend line I showed you today. It's the one I'm going off now, BOD. We did break it today, and when we broke it, you can see we didn't just limp through. We had a nice, impulsive drop, and it took us right to support, which will probably mark the lows of the day, give or take, is my guess. But coming off a big divergent high, so to try to gain bounces at this point, it's a bit of picking up nickels in front of a steamroller. So I just wanted to point that out that, if you took a break of that today or, shorted the highs here the other day when I pointed that as a likely pullback off that resistance level, or again, when we keep hitting that level. So now this is support. We had a reaction here, reaction so far. We've stopped, this drop has stopped right there. And that would be bearish. Again, take it with somewhat of a grain of salt, maybe a pretty big grain of salt until the bulk of the FANGs or big tech stocks until they've reported and they're out of the way. Now with that, it's up to you. You may decide whether you want to take a starter or core position, a short position, or long if you're bullish into earnings, because the thing about earnings is it's likely going to be the catalyst if we are going to go down and hit these. Remember, I gave you these are kind of just the near-term targets. The arrows I drew for you recently show us if we do get rejected here. Oops, went out too far. Let me go back in. My lines don't come back until I do this. Go back 3 months hourly. There we go. This is how I drew the arrows today. Here, reaction, there, reaction, there, reaction. And then this would be kind of lights out number if we take out that recent low. And, we do know that stocks tend to fall a lot faster than they rise, right? We dropped there. It took us, we haven't even gotten back there yet. So that's just how it works. And just be aware that next week is probably going to make or break this scenario. If we go to new highs, as I said, anytime soon, we'll still have, it depends here on the 60-minute chart. On the daily and weekly, we'll still have divergence. I can only take a look at the charts as they develop next week. So just wanted to update that we did break down there on NQ, that trend line today. Sorry, I had to pause it there for a second. Either way, so that's it. That's, again, likely reaction here today. And it's Friday, so we'll have to pick it up on Monday, see where things pick up there, or at least Sunday evening on the futures. And don't read too much into unless there's something huge, the Sunday night, Sunday evening, and early Monday morning trading. It all matters what happens during the regular session, especially next week with the big FANGs coming on. Take any breakouts or breakdowns with a grain of salt, like I said. SPY and SES. Let's get to that for you real quick. There's the breakdown. This is the trend line right here. I gave you, come in nice clean 3 reactions, divergent high there, breakdown, and the first support is right around there, about 61.11-ish. Yeah, there's a reaction low a little bit below that, but again, the NASDAQ 100 just hit support, so that's likely to see some buyers step in there. And if we do go a little lower today, that would be it. I think that'd be your max downside for today. Okay, but again, how far we bounce, based on this, that's a pretty nice divergent high. You know me, I like these divergent highs and lows. I highlight them often. This is the go-to swing trading time frame. And it's there for you on the charts. You can see divergent low, bigger divergent low there, bigger rally. QQQ traders, you have that same trend line I gave to you recently on the uptrend line on QQQ. That was broken, back test with another, just a marginal new divergent high still. It's just, I don't have the DH put there, but you can see it's, we had big divergence that's been coming for a while. Oh, this line here just shows that if we do make a marginal new high soon, it will still be a divergent high on QQQ. And on SPY on the 60-minute chart, you have this little bit of divergence there on this recent thrust up. And again, you have bigger, actually, you have a much larger divergent high. And this shows through better on the daily chart. When you come back all the way back here, you can see the indicators are making lower highs below the previous highs back here. These were higher highs, lower highs. That is negative divergence. So that was divergence there. And it's not as if it didn't play out for a correction. It certainly did. And then we had a divergent low, covered shorts, went long there. And now we have a divergent high. And that is it. All right, what else? I've been communicating my thoughts in the comment sections pretty actively over the last week, trying to get to every question that I've had. I've maintained that I still like treasuries. They took a little breather. TLT, especially when you look at futures. I'll get to the futures in a second, but TLT, beautiful little bullish falling wedge breakout, rallied up, hit that 88.32 second price target. That was the first target there. Had a reaction, as is common on the initial tag, just like you had a reaction off that first tag of the first target. Reaction pull back there, bought that one up, highlighted at the time that we'd likely get one, then again there. And if you look at the PPO, which works as a really good trend indicator, look at the dotted line, the white line. That's the last of the two to cross. So when I use a PPO as a trend indicator, and this works on many time frames, you have to look at each security, make sure it's working well on that particular security. And quite often it does on most of them. Sometimes I will move the line up or down. Instead of using a zero line, the reaction point might be a little higher or lower. But what I'm referring to, it's a trend indicator. So when the white lines are below the, especially again, the white line, the signal line, we call it, the 9 EMA, is below, as it was all of here, except that little period right there, the trend is bearish and you want to be short treasuries, right? Then when you break above what you did right there, you successfully backtest it, and it often acts as resistance on the backtest. You get rejected, rejected, rejected. You broke out there, you backtested, it kept a bullish trend going, and then you had a bearish crossover there, and it said bear trend from this point all the way to right here. And then recently we crossed over, and now we're making a successful backtest. So if TLT does what I think it's going to do and hit that target I've given you for a while now, 89.65, we should move up here. ZB are your treasury bond future for the 30-year, of course, that is. And you can see that as recently highlighted, we hit that 114.023 target. We had negative divergence, so it's normal. We had a little divergent high here first. We got a correction there, a little bit bigger divergent, a little bit bigger correction. But yeah, I have a trend line here with several reactions. And also, as I've highlighted, some pretty decent price support. Remember, this was, I think the second target was at 12, or target zone running from 112 to 235. And I'm still expecting, favoring a thrust up to this level. So it's just so far, it looks like nothing more than just the first corrective profit-taking wave. And so still like treasuries for now. But like anything, don't fall in love. Sometimes even the best looking charts cannot play out. So stops are, commensurate with your entry price, your outlook, your price target, et cetera, et cetera, et cetera. ZN is the 10-year treasury bond futures, and that had that beautiful bullish falling wedge too, big positive divergence, just like you had negative divergence up there before you got this correction there. Positive divergence breakout, ran up, first target hit, pull back, and we've been holding, actually second target hit. That's the second target right there. That was the first target. And but that first target was resistance. Resistance once broken acts as support. And that's what we're doing here. So you could probably even put maybe more of a support zone. You've had a couple punches right down through there. Either way, ideally it holds this level, powers back up, and we've already come close enough to consider that a full hit since it was a hair below. I always say sell below the actual resistance level you're targeting in case the buyers step in early, because a lot of eyes would see it. And so far, that's what they did. And so there's the next stop right there, and then the final max target right there. Okay, I almost like to see articles like this. This one just dropped from the Journal, Wall Street Journal. Nat gas futures down on warmer forecast. This was, yes, the nat gas has corrected last couple days. Futures lower as weather forecasts warm up after this week's Arctic blast and production starts to pick up. So they're telling you, of course, what the Journal does, and only in hindsight did they tell you why something went down or why it went up. I do my best here to tell you when something's going to go up before it goes up and why it'll probably go up or why it may go down. Nobody gets that right. Nobody bats 1,000, not even close. But in this game, you can even bat 500 as long as you're using good RR ratios, meaning you're not risking $1 to lose $1. If that's what you're doing, then you're batting 500, you're breaking even. You might as well just go do something else. So if you use a favorable RR, ideally 2-to-1 or better. I like 3-to-1. Most trades are 3-to-1 or better, but it all depends on the trade. Some of my trades have a 10-to-1 RR, but you do that. And if you bat anywhere, 500 or above, you're making money. That's how it works. Okay, the futures we've now rolled. I've been covering up until recently, the February contracts. There's more volume in the Marches right now. February's are still trading. I think it stops today, if I'm not mistaken. Either way, this is, there was that divergent high. I did point it out there, and we did have a correction. But again, that I'm still maintaining my longer-term target just shy of the $5 level. I don't have that long-term chart up now, but I have been unwavering on that target. And that coincides roughly with the same target I gave you back earlier in the year with that last highlighted entry right here for T8 on natural gas, UNG, the ETN. So we went on, we've already hit, remember that target comes out from really all the way back here. And we hit T1, 2, 3, 4, 5. That's why you see 6 just recently being hit in 7. Maintained all along. We had a divergent high there. We had a correction back to where we started, which was excellent long-term support. Again, the case has been made repeatedly over the last year based on the long-term charts. My weekly chart of nat gas and the futures falling down to the low end of their range. Good support with strong positive divergences, and showed you how those rallies, my target is in line with the average rallies over the last decade or so. And that would be, again, roughly that $4.90-ish, almost $5 target on natural gas futures should coincide with T8. So you have to respect negative divergence. Like I pointed out here, a lot of these rallies end with divergent high and then go back down. However, again, based on the longer-term chart, just like I started this video looking at the longer-term charts of the indexes, that long-term chart gives me bias. A lot of people say it's unhealthy in trading. You're completely Switzerland. You're going to get paralysis by analysis. Sometimes you got to pick a team. So when I'm on the bullish team, I might dismiss things that I'll look for when I'm bearish, like divergent highs. And again, it could be the end of the run. It very well could be. We hit support on natural gas futures. We hit some resistance here on UNG. However, I suspect that they'll power it up. One last thrust up to my final target, and we'll still have divergence, probably just bigger divergence there, setting the stage for maybe a reversal in that trade and swing that gas back down. And like anything else, you've got support here. I showed you support on the futures. Your stops are going to be commensurate where if you're still in this, I don't get a lot of comments on this. I call it the Widowmaker. I know most people do not have the stomach to trade natural gas. I'm aware of that. And you probably shouldn't, especially if you're new to this. These, corrective waves, if you just look at, even though the whole run, and it's been bigger in the futures, but just in UNG alone, when T7 was hit, if you entered there and just, held your nose and jumped in the water, and held it, you made 60% right there. However, in that 60%, you had to ride out pullbacks that measured anywhere from 10 to 20%, double-digit pullbacks. But you rewarded, or you could sidestep those if you're an active trader. Either way, I just wanted to reiterate, I think we're still gonna, and I like that bearish piece the Journal tried to push out. I think that would give that final short covering rally. More shorts pile in on these corrective waves, sink the tops in. And I think if you get anywhere near that recent high, they're just going to explode it. It'll probably be a 1-2 day rally, or just a few days right up to that final target. So, which is still another, from where we're at, another 20% or so. All right, not much more I want to add. The grains are taking a breather. They still look good. The breakouts are still intact. I still like corn, wheat, soybeans, and the related ag input stocks. If you're new to the site, I've highlighted those back starting last year, and highlighting especially again recently once the grains broke out. They're going to take a breather with the grains most likely, but all of them looking good. Quite a few moving up. T2 just got hit. I didn't update that. NTR. Coming off that divergent low. So just, since the grains broke out, and I highlighted it the day after. I highlighted the breakout of the grains on a Friday, and then Monday I made sure to reiterate, as I had when I first covered these, that they would most likely start to run now that the grains broke out. And so, that's been 25% for you in NTR since then. CF, everything, some divergence. You're going to get corrections, but pulled back to the trend line. There's an objective buy point. Still not to my second target. Mosaic recently broke out. So I still like these guys. What else? That's about it. The only other thing I should have covered with the broad markets are the two biggest, Apple and Nvidia. I have lots of different boards, if you will, on Apple. I highlighted the other day that Apple fell to the 200-day moving averages. Folks just love them some 200 days on Apple. That's just a long-term thing. When you look back for as long as you want, I'll put on a weekly chart. When the stock is above the 200-day, it's in a bullish trend. It took them out there, and you buy pullbacks. These are the blue and the red lines of the 200s here on this weekly chart, also known as on a weekly chart a 40 period, but it's a 200-day moving average. There it is, breakdown there, back test. You would have slayed these two bear and bull markets. There are some whipsaws, and that's fine. If you get a whipsaw, just reverse. If you take the sell signal on a weekly close, it's a weekly chart. This is going to keep you in with fewer whipsaws than trading it on the 200-day on the daily chart, which is a 200-day or 200 period moving average. And that's it. So all I can tell you is we're there. So you might say, well, and I did. I said, hey, if you're bullish, buy Apple. Just buy pullbacks to the 200. It's that simple with stops somewhat below. However, remember, we're coming off a big divergent high, something I've covered many, many times in the past. And the day people stop believing, or day I stop believing in technical analysis, is the day I need to find another trade. So these things don't always play out. Like I said, divergences are not sell signals, they're conditions. But all these divergent highs on the weekly were followed by bear markets of 42, 62, 26, 45, 32, 34, 39, 32, all around 30% or more. And what is a sell signal is highlighted recently, and I covered that at the time. Breaks of support. We had that minor trend line break right there, which again I showed you on the daily chart of Apple. That was the minor trend line break there. On the weekly, this is what I showed on the weekly. That was a pretty significant trend line coming off the April lows right there. Broke down, and it took us there. Point being, you bounce off the 200 until you don't bounce. I know that sounds like a yogiism, but buyers will buy pullbacks to the 200, and then one day it stops working, and then a new downtrend or bear market has started. So keep in mind that if we didn't have the big divergences, I'd be aggressively buying Apple right now. We do have the divergences. It's not a bad hedge, but you have earnings coming up. My opinion, just best to sit back and let's see what happens next week, and then we'll look and see if it's either a buy or a sell on Apple. But overall, we've had a lot of bear, sell signals, and Apple is the second largest. It's been for a long time. It's leapfrogged back and forth with NVIDIA over the last year, but for quite a while it held the reign as the largest publicly traded company. And NVIDIA, as of today, according to my charting platform, is a hair higher. They're right there next to each other. Remember, NVIDIA, we had that bearish engulfing candle, which still marks the high so far. We have big divergence. It's been building for a while. It shows even better on the weekly chart because it's such large divergence. This is my weekly chart. These are targets I gave you back in 2021. My second target was hit there with positive divergence on the indexes at the time. Those were the T2 laid out back here. There was your sell signal, breakdown back test. Then I gave you targets back last year. I gave you a total of 4 current targets. These are just potential. Potential doesn't become effective until I remove the potential. So this is still my final target, $40. We went down, we hit my first target. We bounced as expected the very morning of at the exact lows. We covered NVIDIA and all shorts on the site. That was the post on August 5th. Cover all shorts, going hard, aggressive long. And because for numerous reasons. I mean, this hit the uptrend line. It was a price target. It was a key Fibonacci retracement level. It was a 200-day moving average. On a scale 1 to 10, this was an 11 for covering a short on NVIDIA and buying it. So we got the expected bounce. Trades, that's why multiple targets are listed. So if this thing does play out, the charts do play out as indicated, the next stop will be, tradable bounce will be down here around T2, around the 50% fib retracement, and that should be about a 48. The 48, these percentages are measured from this high. We made a marginal new high there. But remember, whereas in last time we hit this trend line, and then I highlighted again there and there, we've been bouncing. We took out that primary uptrend line right there. That's a key uptrend line, comes back from the October 2022 lows. You can see it here in blue, very, very well defined. And so what's happened recently was a breakdown, back test, rejection. We're still below it. And who knows, maybe we want to back test it again. When this becomes bullish is if NVIDIA clearly takes back that trend line, especially on a weekly closing basis. Even more bullish if it can power through and take out this divergence. You won't want to ride that out short, so you got to decide where you want to be. You can keep a stop right above that bearish engulfing candle. That's one option right there. Or maybe not too far above the trend line if it's taken out. Again, if you are in a long-term short position for NVIDIA. Other than that, if you want to wait, be a little bit careful, do that whole second mouse gets the cheese thing, just wait for that 133-ish level to clearly get taken out. And then especially the 200s. If the 200s go, this price support, this whole trading range here will be taken out. If that goes, especially on a weekly, a big red weekly candle through there, then I would say the odds of my T2 level being hit go up sharply. T1's already been hit, so I don't have to worry. I'm not saying we don't have to worry. It's still support. Still might get another reaction there, but it increases the odds that T2 will be hit whether we get a reaction or not. All right, so that's it. I could go over a gazillion other things. I've thrown a lot of trade ideas out, long and short individual stocks. In some of the comments that I've made recently, my MO lately has been, well, first of all, keep it light over last week, keep it light into next week with the big fangs reporting. Let's see how, how the chips fall then. Also diversification. It's been a trader's market, plenty of long trading ops on individual stocks and sectors, plenty of short trading ops, commodities, various commodities, some bullish, some bearish, precious metals, you name it. And that's it. So if you spread your bets, that's the key to both investing and swing trading, in my opinion. Don't put all your eggs in one basket. You're either going to be very happy or very sad. And over time, a concentrated position sooner or later is going to hurt you. So spread it out and know when to engage anything aggressively, be it the market or gold or whatever you're trading. And right now, it's kind of a meh, the charts overall. All right, guys, I'm going to wrap it up here and get started with my weekend. This has been Randy Finney with Right Side of the Chart. Have a good one.